Ever wondered what happens when a major mixed-use project is set to transform a landscape? Well, in Palm Beach County, such a transformation is on the horizon. Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a captivating development, a major mixed-use project in Palm Beach County is seeking approval, marking a significant potential shift in local real estate dynamics. The project, known as the Marketplace at Wellington, is poised to bring a blend of residential, commercial, and hospitality spaces to the area. This ambitious plan includes the integration of shops, restaurants, offices, condos, and a hotel, creating a vibrant hub of activity. The project is spearheaded by Wellington Lifestyle Partners, who envision a thriving community space that caters to a diverse range of needs. This development is part of a broader trend seen across the United States, where mixed-use projects are gaining traction for their ability to create self-sustaining ecosystems that enhance both lifestyle and economic opportunities. Looking north to Canada, particularly in regions like Kitchener-Waterloo and Cambridge, Ontario, similar developments have been met with enthusiasm, reflecting a growing appetite for integrated living and working spaces. These projects not only meet the demand for multifaceted urban living, but also drive local economic growth by attracting businesses and residents alike. In the United States, mixed-use developments like the Marketplace at Wellington are becoming increasingly popular, highlighting a cross-border trend towards urban centers that combine residential, commercial, and leisure spaces. This approach not only maximizes land use, but also fosters a sense of community and convenience for residents and visitors. In a noteworthy transaction, the multifamily development parcel at Bergen Town Center in Paramus has been sold for $25 million. This development, set to feature a 426-unit multifamily complex, was acquired by a joint venture between Russo Development Limited Liability Company and KRE Group. The sale was orchestrated by JLL Capital Markets, reflecting a continued interest in mixed-use projects that blend residential and retail spaces. The development is strategically positioned adjacent to Bergen Town Center along Route 4, a prime location in Bergen County. The project will be developed in two phases, with the first phase consisting of 166 units and the second phase comprising 260 units. Each phase will offer 4 floors of residential space above 2 or 3 levels of parking, complemented by a Class A amenity package and 2 retail suites totaling approximately 5,000 square feet. This development is indicative of a broader trend in the real estate market, where malls are increasingly incorporating multifamily and retail elements to enhance competitiveness. Senior Director Ryan Robertson of JLL noted this wave of larger redevelopment projects, underscoring the synergy between residential and commercial spaces in mixed-use developments. Urban Edge Properties, the seller of the parcel, is a real estate investment trust with a focus on managing and redeveloping retail real estate in urban communities, particularly along the supply-constrained corridor between Washington, D.C. and Boston. The acquisition by Russo Development, a Karlstadt-based developer specializing in industrial data center and multifamily properties, and KRE Group, a family-run developer from Jersey City, highlights the collaborative efforts in advancing such multifaceted projects. In a significant development for the commercial real estate sector, lending activity has surged in the first quarter of 2025, providing a strong signal of renewed momentum. According to the Mortgage Bankers Association's latest quarterly survey, commercial and multifamily mortgage originations increased by 42% compared to the same period last year. Although there was a 40% decline from the typically more active fourth quarter of 2024, the year-over-year increase highlights growing confidence in key real estate segments. Reggie Booker, Associate Vice President of Commercial Research at the Mortgage Bankers Association, commented on the data, noting the strong gains in office, healthcare, and multifamily lending. Despite ongoing volatility in interest rates and broader financial markets, opportunities are being found to move new deals forward, reflecting a positive outlook for the market. Breaking down the year-over-year growth, office property loan originations led the charge with a remarkable 205% increase in the first quarter of 2025 compared to the same quarter in 2024. Healthcare property lending closely followed with a 159% rise. Multifamily loans also saw an increase of 39%, while hotel property originations were up by 30%. In contrast, loan volume for industrial properties fell by 2%, and retail property originations declined by 3%. Investor participation has also risen, with depository institutions increasing their lending volume by 83% and life insurers boosting activity by 61%. Commercial mortgage-backed securities originations rose by 37%, and government-sponsored enterprises like Fannie Mae and Freddie Mac increased lending volume by 20%. Investor-driven lenders grew originations by 12%. Compared to the fourth quarter of 2024, total originations fell by 40%, aligning with seasonal patterns. Lending for retail and hotel properties saw the largest declines, down 66% and 64%, respectively. Industrial property originations dropped by 43%, while multifamily and healthcare properties saw decreases of 41% and 34%. Interestingly, office lending was the only segment to increase quarter over quarter, rising by 44%. The Federal Reserve Bank of Kansas City's first quarter 2025 commercial real estate index rose from negative 0.76 to 0.40, indicating regional activity is now slightly above its historical average. According to Nicholas Sly, vice president at the Federal Reserve, the gains were largely driven by ongoing construction, material inventory growth, and property completions. However, the influx of new commercial space has tempered rents in several segments within the Kansas City Fed region. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.